The first question most people ask, which is better, an ETF or a mutual fund, sounds simple and is almost always asked in the abstract. The better question is, given how I put money in, how I take money out, and how my brain behaves when markets move, which wrapper gets me to my goal with less friction? ETFs and mutual funds are not rival religions. They are containers that hold the same stuff, stocks, bonds, or a mix. The differences live in how you buy them, how they're taxed, how they price during the day, what they cost, and how they interact with your habits. The right choice has less to do with what pundits praise and more to do with the calendar you live by. Start with what they share, so we don't inflate distinctions. Both ETFs, exchange-traded funds, and mutual funds can give you instant diversification, a broad basket of companies or bonds with a single purchase. Both can be passively managed, tracking an index, or actively managed, a manager picks holdings. Both come with an expense ratio, the annual fee taken from fund assets, and both distribute dividends and interest. If you buy a low-cost total stock market index, whether in ETF or mutual fund form, your long-term return will rhyme because the underlying holdings are nearly identical. The container shapes the user experience. The contents drive the growth. Now, where do they part ways? The first fork, how they trade. ETFs trade on an exchange all day, like a stock. Their prices move every second markets are open, and you buy them through a brokerage account with the current bid-ask spread. Mutual funds, by contrast, trade once per day after the market closes. Everyone who buys or sells that day gets the same price, the net asset value, or NAV, calculated at the close. This difference sounds cosmetic until you live a few months with each. If you are tempted to react to intraday swings, it dropped 2% this morning, should I buy? It popped, should I sell? The ETF format can feed your impulses. If you want to automate contributions on a schedule and ignore the clock, mutual funds once-a-day pricing takes volatility off the table. The flip side, ETFs give you flexibility for same-day moves, limit orders, and tax loss harvesting with precision. Mutual funds ask you to live by the calendar, not the minute. That trading difference creates the second fork, costs that aren't in the expense ratio. ETFs carry a bid-ask spread, the tiny gap between what buyers bid and sellers ask. For large, liquid ETFs, the spread is often pennies. For niche or thinly traded funds, it can be meaningful. If you contribute every paycheck, frequent small ETF buys in thin funds can leak a little through spreads. Mutual funds have no spread, you just get NAV. But some mutual funds have purchase or redemption fees, and some brokerages charge transaction fees to buy funds from other families. In 2025, many brokers offer commission-free trading on a wide slate of ETFs and an open supermarket of no transaction fee mutual funds. The lesson is to check the all-in cost for the exact fund you'll use at the exact platform you'll use, not just the headline expense ratio. Tax structure is the third fork, and for taxable accounts, the most consequential. ETFs are typically more tax efficient than traditional mutual funds because of how they handle creation and redemption of shares. Authorized participants can exchange large baskets of the ETF's holdings in kind, which lets the fund offload low-basis shares without realizing capital gains that flow to shareholders. Mutual funds, when faced with redemptions, often have to sell holdings to raise cash, potentially generating capital gains distributions you pay taxes on even if you didn't sell your own shares. There are exceptions. Some mutual fund families operate very tax-efficient index mutual funds, and some ETFs distribute gains after rebalances or in unusual markets. But as a rule of thumb, for long-term taxable investing, ETFs usually leak less tax along the way. In tax-advantaged accounts, 401k, IRA, ISA equivalents, this difference shrinks because distributions aren't taxed each year. Minimums and automation form the fourth fork. Many mutual funds have minimum investment amounts, $1,000, $3,000, sometimes more, though some waive minimums if you set up automatic contributions. ETFs have no fund-imposed minimum. You can buy as little as one share, and with fractional share trading at many brokers, even less. Where mutual funds shine is automatic investing. You can schedule buys directly into the fund from your bank on payday, and the fund company pulls it off quietly each month. ETFs rely on your brokerage's automation features. Some platforms now let you set recurring ETF purchases, including fractional, but the experience varies. If automation is your lifeline, confirm your broker can auto-buy ETFs the way you want. If not, mutual funds may be the calmer tool. Intraday tools are the fifth fork. ETFs give you limit orders, stop orders, and the ability to place trades outside normal hours at some brokers. They also let you concentrate donations or gifts easily by transferring shares. Mutual funds offer none of that. If you're a set-and-forget investor, those tools are surplus. If you tax loss harvest, rebalance across accounts, or roll large positions, ETF flexibility can save taxes and tighten execution. The trick is that tools cut both ways. The same features that enable smart, occasional moves also invite fiddling. Choose the container that matches your temperament, not the one that flatters your intentions. Expense ratios used to be the sixth fork, with ETFs claiming the lowest fees. That gap has narrowed. For broad market exposure, the cheapest index mutual funds and their ETF twins often have identical expense ratios. Where differences persist is in distribution costs and share classes. Some mutual funds include 12b1 fees for marketing and distribution, and some have load share classes sold through advisors, costs you should avoid. ETFs avoid loads and 12b1 fees by design. If you want cheap and simple, stick to institutional-style index mutual funds with no loads, or equivalently, their ETF twins. If you see multiple share classes with letters that sound like alphabet soup, A, C, R, I, stop and check what you're actually buying. Rebalancing and dollar cost averaging introduce the seventh fork, mechanics. With mutual funds inside a retirement plan, rebalancing is frictionless. Exchange from one fund to another at NAV, often with no fees, all at once. With ETFs, rebalancing involves selling one ETF and buying another, subject to spreads and potential taxes in taxable accounts. It's still easy, but there are extra dials to mind. Dollar cost averaging works with both, but mutual funds were built for it. Schedule a monthly purchase and forget it. ETFs can match this only if your broker supports recurring fractional buys and if you're comfortable ignoring the intraday fluctuations that will show up on your screen. Behavioral guardrails are the eighth and last fork, and maybe the quietest. The best container is the one that helps you behave. If you are tempted by the flashing lights of intraday prices, mutual funds create a speed bump. If you obsess over getting the best price on Tuesday at 10:12 a.m., ETF visibility will either soothe you or ruin your week. Examine your past. Do you check prices daily? Do market drops make you want to do something? If so, a mutual fund in an auto contribution loop may be your sanity. If you are a calm operator who values tax loss harvesting and same-day rebalancing, ETFs are fine companions. Let's bring it down from theory to scenarios. You're a beginner with a paycheck and a promise to invest on payday. You want one fund that buys the whole market, and you plan to leave it alone. A total stock market index mutual fund set to auto-invest each month is almost unbeatable for simplicity. If your broker can do recurring fractional ETF buys easily, the ETF version is equally fine. Pick the wrapper that your platform automates best, ensure the expense ratio is minimal, and get out of your own way. You're building a taxable investing plan alongside retirement accounts and care about tax efficiency. An ETF that tracks a broad index is likely to minimize capital gains distributions over the years. Pair it with a municipal bond ETF if you need bonds in taxable, and keep your less tax-efficient assets like REITs, bond funds with lots of income, inside tax-advantaged accounts. If the mutual fund version has a pristine record of minimal distributions and you prefer its automation, that's a valid choice. Just don't let inertia keep you in a fund family that kicks off gains every December.
You're in a 401k or workplace plan. The plan's menu decides. Many plans offer institutional index mutual funds with rock-bottom fees and no trading costs. ETFs may not even be an option. Take the cheap institutional funds without overthinking the wrapper. Your control lever here is savings rate, not the ETF/MF choice. You're a hands-on optimizer who rebalances, harvests losses, and donates appreciated shares. ETFs are your friend. You can harvest specific losses during downturns, swap between similar but not substantially identical ETFs to maintain exposure, and donate shares with the largest built-in gains to charity. All of that is possible with mutual funds, but is often clunkier and in some families impossible. Precision is an ETF feature, not a fantasy. You invest small amounts irregularly. Fractional shares have blurred old limitations. If your platform lets you buy fractional ETF shares on a schedule, ETFs are fine. If it doesn't, mutual funds remove denomination issues. 100 euros buys 100 euros, full stop. Some brokers' ETF auto-invest tools still feel bolted on. Try a dry run with a small amount to ensure it works the way you want. You're overseas or in a region where fund structures differ. Local rules matter. Some markets tax mutual fund distributions differently from ETF distributions. Some have reporting fund statuses you must check to avoid punitive taxes. Some platforms restrict U.S. domiciled funds for retail investors. In those situations, the which is better question must bow to which is compliant, cheap, and available. Read your local rules first. The wrapper is secondary to legality and cost. There are edge cases where mutual funds have unique advantages. Automatic investment with custom paycheck splitting directly from your employer into multiple funds is often smoother with mutual funds. Some target date mutual funds inside retirement plans have institutional pricing you can't get in ETF form. Some active mutual funds, especially closed to new investors, have records and managers you specifically want. If you value those features, accept the wrapper that delivers them. And edge cases where ETFs clearly win. Transparency. ETFs publish holdings daily, while some mutual funds publish monthly or quarterly. Liquidity during market hours. You can raise cash or deploy cash without waiting for the close. Tax efficiency in taxable accounts, especially for small, frequent rebalances. Portability. ETFs are easy to move between brokers without selling. Some mutual funds aren't available everywhere. Simplicity of avoiding load share classes. ETFs don't carry them. Now, fees and context. People obsess over a 0.02% difference in expense ratios and ignore a 1% annual advisor platform fee or high fund loads. The big win is avoiding expensive commissioned mutual funds and high wrap fees, then choosing a broad, low-cost index vehicle, ETF, or mutual fund. If the ETF is 0.03% and the mutual fund twin is 0.04%, choose the one that matches your automation and behavior. Your savings rate and time in the market swamp that single basis point. Let's address liquidity panic. During market stress, ETFs can trade at small premiums or discounts to NAV. Thin or complex ETFs can see discounts widen briefly when underlying markets are closed or illiquid. For broad, liquid core ETFs, those deviations are typically tiny and short-lived. If you place market orders at the open or close, you may get a price you don't love. Solution? Use limit orders near NAV if you care, or place trades midday when markets are calmer. Mutual funds avoid these optics by giving everyone the same NAV at the close, but you also lose intraday discretion. Know your tool, don't fear it. Taxes at the end of the journey matter too. When you sell either fund in a taxable account, you'll realize capital gains or losses based on your basis. ETFs make it easy to donate specific lots with high gains to charity or to harvest specific lots with losses. Many mutual fund platforms allow specific lot accounting as well, but some default to average cost and make lot selection clunky. Before you build a large position, ensure your platform lets you choose lots. Future you will thank you during a downturn or a donation. Behavioral hacks to pair with either wrapper. Write an investment policy statement, one page, that states what you buy, how much you contribute, how you rebalance, and under what conditions you'll sell. Hint: rarely, and for reasons like changing goals, better or cheaper proxy for the same exposure, or tax strategy. Turn on automatic contributions and dividend reinvestment. Hide price tickers on your phone if they trigger you. Review quarterly, not daily. Which wrapper you choose is less important than whether you behave long enough to let either do its work. So, which should you buy? If you crave automation, invest primarily in retirement accounts, and prefer to be gently kept away from intraday noise, a low-cost index mutual fund may be your best ally, especially if your broker supports flawless auto-invest and your plan offers institutional pricing. If you invest in taxable accounts, want maximum tax efficiency, and value intraday control for occasional rebalances or tax loss harvesting, a low-cost ETF twin often wins. And if your platform makes ETF automation just as smooth as mutual funds, pick the one with the simplest setup and stop switching for marginal differences that reset your habits. A practical recipe: pick your core exposure, for example, total world or total domestic plus international, with or without a bond allocation. Find the cheapest reputable fund family offering both ETF and mutual fund versions. Compare expense ratios and distribution histories. Check your platform's automation for each, and choose the wrapper that lets you contribute on payday without thought. Then leave it alone and let compounding do what lectures can't. The sneakiest truth is that which should you buy is often a distraction from will you keep buying. People lose more to skipped contributions than they gain by picking the theoretically perfect wrapper. Build a plan you can run while tired. If that means a mutual fund that drafts €300 every payday without you touching anything, that's a victory. If that means an ETF that quietly accumulates fractional shares every week in a taxable account with minimal tax drag, that's a victory too. The market won't grade you on wrapper choice. It will reward you for time, consistency, and cost control. Here is the filter to apply before you hit buy. Will this choice lower my ongoing fees? Will this choice make automatic contributions easier? Will this choice reduce taxes in my situation? Will this choice help me behave? If your answer is yes to at least 3, you've picked the right wrapper for you. Now move on. The work is not in dazzling yourself with acronyms. It's in leaving your money alone long enough to become more money while you build a life you actually like living.